Homebuyers and homeowners waiting for interest rate cuts in 2025 to save money on a mortgage are going to be deeply disappointed. Coming off the heels of massive rate cuts happening all through 2025, the Bank of Canada is projected to continue with interest rate cuts on its overnight lending rate well into 2025. In fact, the British Columbia Real Estate Association projects that variable rate mortgages will drop as much as almost 2% by the end of the last quarter of 2025, which is a massive savings when it comes to having a mortgage. But there is a huge misconception about how the Bank of Canada interest rate cuts will actually affect mortgage rates. And it's setting up both prospective home buyers looking to buy a home in 2025 and anybody looking to renew their mortgage in 2025 for a very rude awakening. This video is not to predict the future, not to predict the future with interest rates and not to predict the future with what's going to happen with housing prices. What it is for, however, is to address for those that are sitting on the sidelines, expecting a massive windfall of savings in 2025 based on what's going to happen with the rates. They're not quite getting the entire story of everything they need to know. And without getting the whole story, people just like you may end up finding themselves in a situation that is hard or almost impossible to escape. I want to tell you a little bit of a story about a young couple named Jason and Sarah, who we helped many years back, who were interested in buying a home, but were hesitant at the time because of all the fluctuation and everything that was going on with mortgage rates at that time. They started seriously looking for their first home on the market, but when interest rates climbed, they decided to wait, convinced that rate cuts were just around the corner. They assumed that if they waited a little longer, not only would rates drop, but the home prices would stabilize or even fall further, giving them a better deal. However, months turned into over a year. While they were waiting for rates to drop, something unexpected happened. Home prices in their area started creeping back up, not by a huge margin, but enough to make a noticeable impact. The type of home they had initially been able to afford, a 3-bedroom townhome in a nice family neighborhood in Surrey, was now out of their reach. Their assumption that they would save money by waiting was just flat out wrong. When Sarah and Jason finally decided to make their move, they were hit with a double blow. Mortgage rates hadn't dropped much, if at all, and rising home prices meant that they had to adjust their expectations. Instead of the townhouse they dreamed of, they ended up buying a smaller 2-bedroom condo simply because that's what they could now afford. Waiting had absolutely cost them, and not just financially, but also emotionally. Not only did they have to level down their purchase, but they also felt, and assumingly so, they were right, that they had missed their chance to get the home that they actually wanted. And this was a really hard lesson for these guys because timing the market is really difficult, and waiting often costs more than acting when the opportunity is right. But hold on a sec, this seems completely contrary to what we're talking about. If interest rates are going to go down, and almost everybody is screaming this from the top of mountaintops, I mean, this is all over the news. Like, how could this possibly be the case? And why would other people find themselves in a similar situation to Sarah and Jason? Well, this is where the misconception comes in. While the Bank of Canada moves its overnight lending rate and continues to move in a downward direction, which everybody is projecting, the fixed mortgage rates, which is what the majority of Canadians prefer and choose when they get a mortgage, is gonna remain much more sticky and much closer to current levels. Let me explain why. Variable rate mortgages are tied to a bank offering as well as the Bank of Canada's overnight lending rate. So as an example, whatever the Bank of Canada is offering to lend money out to these particular banks, well, they need to make profit. So they might offer you a mortgage of something like prime plus 1%. The 1% is the profit the bank makes on top of the Bank of Canada's overnight lending rate. This means that if you were to choose a variable rate mortgage, or you're someone watching this that has a variable rate mortgage, good news, your mortgage is likely going to get cheaper as the time progresses. Well, fixed rates are a lot more complicated than what I just described, and that's because they are reliant on the bond market rather than the Bank of Canada for what interest rates are being offered out to consumers just like you. What's the bond market? Well, let me explain that as well. Think of the bond market like a big lending club where people and companies lend money to the government for a certain amount of time, and in return, they get paid a little extra money called interest for lending it. The government uses bonds to borrow money, and the bond market decides how much interest the government should pay based on how they think the economy is doing. Now, here's how it affects mortgage rates. When people lend money in the bond market, they want a safe deal. If they think the economy is risky, like it might get worse or there's high inflation, they'll demand more interest for lending money. That makes fixed mortgage rates go up because mortgages are tied to the same type of borrowing. But if the bond market feels good about the economy and thinks that inflation will stay low, well, they're okay with getting less interest. This makes fixed mortgage rates go down. So fixed mortgage rates follow the bond market because banks use bonds to decide how much it costs to lend you money for a long time, like a 5-year mortgage. And it's why fixed rates don't always follow the Bank of Canada, because they're listening to the bond market instead. Here's an interesting point. Historically, fixed rate mortgages are more expensive for a consumer to buy than a variable rate mortgage. And this is because lenders offering a fixed term amount, well, that is a more risky bet for them. While this is a safer, more predictable option for the people borrowing the money, the variable rates carry the risk of future increases tied to the Bank of Canada's rate changes. In 2024, this flipped because the Bank of Canada's aggressive hikes pushed variable rates unusually high, while fixed rates remained relatively stable due to the bond market expectations of an economic slowdown. The same economic slowdown that we are experiencing right now at the time of filming this video. And really, choosing which type of mortgage you get is probably all about saving money. And it's worth mentioning, if you're interested in saving money, check out the description of this video for a download that we're making available called 21 Grants and Rebates for both home buyers and homeowners, where you can really save a ton of money on your purchase. And you don't have to dig through all this buried government information to find out what money you're entitled to. So check it out in the description. So now that we understand that variable rates are tied to what the Bank of Canada does, but fixed rates are more tied to the bond markets, let's go back to our friends at the British Columbia Real Estate Association and see what they predict is going to happen for fixed mortgage rates and compare them to what they think is going to happen to variables. While it was projected at the start of Q1 that variable rate mortgages, in comparison to the end of Q4 of 2025, the British Columbia Real Estate Association predicted that variable rate mortgages would drop by over 2%. But if you compare this to the 5-year average discounted rate at the start of Q1 of 2024, their mortgage rate forecast was for mortgages to be at 5.25%, and by the end of Q4 of 2025 at 4.6%. This means that they projected that variable rates would change by over 2%, while fixed rates, well, they would only move by roughly about 0.5%. Not quite the significant savings that someone like you or someone looking to buy a home might be planning for. So home buyers like you, or if you know somebody that's considering buying a home, perhaps you share this video with them or at least like it to help the YouTube algorithm send it out to more people like you that might find it useful. They're going to have to weigh information just like this against what they think might happen with home prices in our area. This is, of course, something that we track and comment on very regularly in this YouTube channel, as well as provide a ton of data. So if you're not subscribed, you should consider doing so. So what are the 3 takeaways from this video that I want to arm you with to put you in the best position if you are someone that's looking at buying a home in 2025 or looking to renew your mortgage? Well, the first one is to consider a variable rate mortgage. Clearly, they are projected to decline into the end of 2025. They also give short-term flexibility because many lenders allow you to switch to a fixed rate later on, sometimes without penalty. And there's many studies that are available that suggest long-term variable rate mortgages end up being much cheaper for the consumer than a fixed rate mortgage because, again, fixed rate mortgages are tied to the bond market. And historically and traditionally speaking, variable rate mortgages are much lower in terms of carrying costs than that of a fixed rate mortgage. This just wasn't true over the last couple of years. Number 2 is work with experts. You want to consult with a mortgage professional for your options. They have access to a wide range of products from various lenders, often including options that your bank may not offer. They can guide you through a great conversation about variable rates versus fixed rates and help you make a decision, or even find you a lender that might offer a hybrid type mortgage. You also want to speak with a real estate professional to get really great data on what is going on in the market. And if you'd like to speak to me and my team, you can find a link below in the description or the pinned comments where you can set up a time to speak directly with us. We can help you understand this in more depth. And the third thing on our list is to focus on readiness rather than trying to time the market, something that has proved proved to be historically difficult, if not impossible to do. There's been many a person that has priced themselves out of the market as the market began to ramp up because they were waiting to do their move for whatever reason. And in this case, it could be waiting for lower rates. But regardless of what the reason is, focusing on readiness versus timing might just prove to really help you in the long run, like it's done for millions and millions of people across Canada. And your journey doesn't have to end here. There's so much more that you can learn about this topic, about the market, what's happening with the market, and even how to get started in terms of buying a home. And maybe you're not ready to pick up the phone and call a professional today, but maybe you want to continue down this path a little bit further and learn as much as you can about buying a property. Well, if you've already subscribed to our channel, I'm gonna see you over on the next video, which is our full presentation and breakdown that we do for people just like you who are looking to buy a home to make sure they've got all the information they need to be wildly successful. That's coming up next, and I'll see you over on the next video. Cheers.